guys, it is May from Markets with May, and today we're going to talk about Blackstone video. And I have been for some time, and I wanted to do this video because essentially I saw a lot of news flow on this, and the news flow was pretty bad as far as that goes. I mean, it was like straight up misreporting what happened in the quarter. And so I was thinking, hey, that's not good. We need to go ahead and post something on Blackstone because obviously they didn't have a bad quarter. Past performance is not indicative of future returns. I am definitely long Blackstone, both in the options market as well as in regular stock, because essentially when it went down and got clobbered with all the financials, that didn't make any sense because Blackstone, first of all, having as much cash as it had on balance sheet, and I'm going to show that to you, really is one of several different kind of lenders of last resort. Like if we're going to get through any kind of financial crisis, to the extent that private equity is well capitalized, they typically are winner, winner, chicken dinner. All right, let's go through this a little bit. Let me show you my slides. I've kept it kind of short, but here's why people got very confused. Now, if you just go through the numbers and you don't really know how to read the numbers for private equity, then you're going to look at distributed earnings. You're going to see down 39%, and you're going to be like, oh my gosh, earnings are down 39%. The world is falling off. And then you're going to go to realized performance revenues. You're going to see down 82%. You're going to add these numbers up, and you would be flat out wrong, for lack of a better way to describe it. You'd just be wrong. That's not how you look at private equity numbers at all. And the reason you don't look at it that way is because for private equity, it's a lot like real estate investment trust. There's realized and then there's unrealized gains. And when you have unrealized gains, it would be the equivalent of asking someone to every year always be selling something that could be worth more in a different environment. So that is the number one place that people got it wrong. Just like right this minute, it would be like, okay, so last year, a huge component of the assets that comprise Blackstone are real estate. So last year, 100%. Sell it as much as you can. Rates are at 2%. Everybody's buying at top value. Knock yourself out. This year, I don't want you selling at all. That's why you have realized performance revenues significantly lower. It's not because the actual assets on the book are worth less. So whoever wrote all of these news stories, and there were a lot, there's not just one news organization that got this crazy wrong. There's actually quite a few that got it crazy wrong. They did not conceptually understand what a private equity firm does, which is they buy assets and then they sell them in exactly the right markets to fully capitalize it on behalf of the shareholders. That's their business model. Okay, so what do we look at? We actually look at the top part, which is fee-related earnings. And then we think of it this way. Fee-related earnings is basically people gave them money and they get to take a cut of that money just for holding the money. And so number one, did that money go up or down? And the answer is it went up. It didn't just go up, it went up a lot. People gave them a lot of money. That's the total assets under management line. They grew that by 6%, despite the fact that we're in a rough market. So people gave them more money, okay? That right there is a big deal. Then the other thing we always want to know, just like with your own house, your house doesn't lose value unless you have to sell it into a bad market. But as long as you're living in it, or if you've got real estate, people are paying rent, it's cash flowing like crazy, then actually it doesn't matter what it's priced at. Okay. And we're going to actually really drill that home as I go through the numbers this quarter. But essentially, yeah. So they don't have any kind of problem with getting money. People are giving them money, if anything. And that itself is kind of good to note for pretty much all of the private equity companies. And also, by the way, Jamie Dimon talked about the fact that private equity was doing fantastic and that they were winner, winner, chicken dinner in all of this mess. Couple other places that we're going to see that here. All right. So number one, a lot of folks use these numbers, distributed earnings. That's wrong. Some people use something like, segment revenues or whatever, all wrong. Every single one is wrong. The numbers that you need is fee related earnings up 12%. And then you just need to double check that nothing crazy happened here such that you do have an actual asset impairment. and you don't have an asset impairment. So whatever anyone wrote there is just wrong, for lack of a better way to describe it. Okay. This is even harder for people to read, but that's also the extended financials. Now, I want to show you this. This actually drills home what I mean by when you look at the assets, if there's no impairment and if there's still some sort of cash flow happening from it. Okay. When you buy a property and you sell it, just like in private equity, I'm using this as an analogy. Okay. Because when you buy business in private equity, in some cases, you're also buying a property because private equity has huge real estate portfolios. When you buy that property, there's two ways that you're looking to make money off of it. If you've got this crazy market where the asset price is being bid up like last year, then yeah, you're looking to buy and sell it. That would be closer to what they mean by opportunistic here. But actually, opportunistic has a little bit of a couple of other things going on there. Okay. But usually you're buying the asset for the cash flow of the rent. And what do we know about rents? Rents have been going up, period, with the exception of office, which is not the bulk of Blackstone's portfolio. Rents have largely speaking been going up. And I covered that in a previous video, which I've posted in the show notes here, where I go through KKR, Blackstone, and Apollo, but all of them have the same dynamic. Okay. So within opportunistic, what do these numbers mean? It's a little bit funky because they decided to use LTM. They're really talking about trailing 12 months. So this was the returns that they saw in the portfolio. So yes, there is a ton going on in the news about Blackstone and redemptions from some of the pension fund managers, yada, yada. Overall, the opportunistic portion is flat. Okay, that's stuff that they bought that they thought was cheap because it was distressed, and now they're holding it. And yeah, there was a thought process that they would flip it, but at the same time, they're going to hold it for now and just let it cash flow out. There you have trailing 12 months. That's, I guess, their verbiage is they use LTM. Everybody uses a different abbreviation. It's so annoying, but down 3%. But the core portfolio, which is slightly bigger, is up 1% in the last 12 months, with this particular quarter showing much better. And that's 100% due to the fact that rents have increased because Blackstone has a ton of single family home and also apartment rentals, and they're making money off of them because they're raising rents just like everybody else is. Let's talk about the private equity piece. Private equity piece is doing great. Why? Because corporate private equity, takeover opportunities, all that stuff it's not being as competitively bid as it used to be because people can't get financing. Okay. Blackstone, however, I'm going to show you in a second, has a ton of cash. That's why Blackstone, KKR, Apollo are doing so well. So private equity piece of the business, doing great, up 9.7% on the year. Some of you might be like, but hey, the markets might be up a little bit more than that. Doesn't matter. Different asset class. Okay. This is still considered a win. And then secondaries is the only piece that isn't doing as well. And that's just bringing your stuff to market. The IPO market has been closed and the secondary market isn't that much farther behind it. So, that's kind of what we're seeing there. But the real gem here is credit and insurance. That is going crazy good. And the reason it's going crazy good is that private equity, unlike a bank or unlike other places, they can hold to maturity all they want. That's actually the nature of this business. Private equity has the longest duration of any type of asset. People that invest in private equity are not asking for their money back anytime soon. There is a concept of a lockup, and that lockup is usually fairly long dated relative to other types of funds that you might invest in. So as a result, what's happening in credit insurance, and they said this on the call, is that no change in risk on the liquid credit portfolio, no change in the amount of risk you're taking, but they're getting 700 basis points more than they normally would, is what they said on the call. That's fantastic. I mean, that is a huge yield. That is a huge benefit to them. This is 100% what they're doing is they're going to banks that do not want to keep so many loans in their books. And the banks and the private equity firms are getting together and talking about, well, how do you want to do this exactly? What kind of financing do you want to take? Do you want to buy it outright? Do you want to collaborate together to do a loan? That sort of thing. Now, does that happen in every environment? Yes, it does. It always happens. But just right now, this minute, because banks are being asked to hold more capital, to reserve more capital, et cetera, the private equity guys have the stronger negotiating power at the table. So that's what's happening in private equity. That was completely reported incorrectly this morning. Okay, let's look at some other things that I thought were very interesting. Here you can see specific to Blackstone. One of the things that I think is really fantastic is how much they took in inflows for trailing 12 months. They took 158. This is in billion, 158 billion. It's a crazy number, right? 158 billion is what they got in inflows despite last year being crazy, right? And they haven't deployed, they've barely deployed half of it, just over half of it. So they are sitting there with a ton of money. How much money are they sitting there with? 194.5 billion B in dry powder, which is up from the previous quarter, which was 186. They still have, despite deploying some capital, 19% of their total assets in dry powder undrawn. This is really fantastic to the extent that we are still in any way, shape, or form worried about the current environment. Blackstone will be just fine. If anything, they'll be better than just fine because the banks still haven't gotten to a point where they have puked out assets for the purpose of being allowed to invest in new things. Okay. That is a little bit of a longer discussion, but essentially, what happens when you have held to maturity is not banks take a loss. What happens when you have held to maturity risk is banks don't get to churn their portfolio as often as they used to. Portfolio churn, okay? This is the equivalent of you not being able to sell your inventory. You just have to hold your inventory, but you don't necessarily take a loss on the inventory. So eventually, the market will get to a place where the banks will be tired of doing that and they'll just be like, fine, I'll take the L. Let's figure this out, that sort of thing. And then Blackstone will have a bunch of great dry powder to do something interesting with. Alternatively, in real estate and a couple of different other areas where you're starting to see stress, the investors will just give up and sell, and companies with this size and this amount of capital will just be winner, winner, chicken dinner. So that is what's happening at Blackstone. I also want to show you this just so you can kind of, if you're coming up to speed on how do I think about private equity in general, how do I even look at these companies? There is of the total assets under management, they charge a fee on most of it. Okay. So 294, they have $1 trillion in assets, 73% of it, they just charge a straight up fee. You give me $100, I'm taking 2 and 20, 2%. And then anything I make above a performance, I'm going to take 20% on the earnings of that. Let's call it like that. This is not so different from a mutual fund. When you have fund fees for the mutual fund, you pay sometimes 1%. You don't necessarily pay a performance fee, but it's the same thing. So just having fee-based assets, that's great. Perpetual capital, that's usually the partnership capital. So the partners of Blackstone actually comprise a huge component of that capital. So this is very sticky capital, right? That's amazing and that's great. And that's just kind of the mix that you want to see. Now, you can kind of see the mix of how that's laid out and where they've deployed that capital. You're seeing, everybody's so worried about real estate. The fact is, real estate in this type of market where you have supply constraint, everybody wants to say everything else. I don't care, because when you have a supply constraint dynamic, particularly in most of real estate, office is kind of its own chill out thing to the right there, rents go up. It's as simple as that. So what you'll expect to see cash flows continue to be really exciting, and cash flow from the real estate portion of the portfolio, as well as other pieces of the portfolio that have those characteristics, they'll just keep paying out. And you will continue to see the earnings look like this until such a time that the market recovers. And then when they make those asset sales, it's crazy. It's like a crazy delta. It's a crazy payout when they go to sell it. So here you can kind of see fee-related earnings. That's up 12%, nice and chill, no drama. That's going to continue. If anything, we'll see continued growth in it that's over and above inflation, which is a big, awesome deal. Okay, anything else that I just want to show you from this? Oh yeah, the final thing that I would just show you, you can already see that from last year to this year, just in the brown box, you can see that there's an increase in the brown, which is credit and insurance. That's 100% them gearing up to take assets at a good price from the banks. Okay. Period. End of story. And I'll give you one little hint on which particular bank Apollo Group is taking it from. That would be Credit Suisse. Okay. And given that UBS has now absorbed Credit Suisse, that there's probably more to be spit out from Credit Suisse at a great deal. I'll be watching for that when UBS reports earnings. Now, a couple other little notes, because it is a long call. There's some interesting things. There were three areas that they really talked about that I thought were really good intelligence. The first was, where in real estate are they most interested? And that would be the UK. They think that the bearish sentiment of the UK has gotten to a fever pitch, and that there's tons of opportunities there to go in and finance that. And people are deal takers, they're not making you or trying to negotiate too hard. They just want out. And so the UK property market is where Blackstone specifically is looking. Additionally, they see in private equity, but also this carries a bit into real estate as well. They see huge opportunities in infrastructure financing. And this makes a lot of sense because it was supposed to be the banks in every local region that finance the infrastructure, in particular the infrastructure bill that we just pushed through Congress during COVID. Now, maybe not. Okay. So they are seeing both, them being the winner of that, and also banks wanting to partner in order to get that exposure, because it turns out infrastructure loans that you make are beautiful, cash flowing, pay you back, understand very simply how the revenue works kind of loans. So that is another area that Blackstone plans on winning. And then in private credit as well, it's just banks flat out reviewing the book and wanting to deliver. I'll give you a little hint there as well. It's usually the fourth quarter that the banks do this the most aggressively. It's a very common known thing that they will go through and see who looks like the nastiest as far as credit defaults look, and just to wash it out on any kind of loan losses, they'll just sell it at an affordable rate. And that can be winner, winner, chicken dinner. In the past, because we've got asset prices going up like this, there haven't been as many sales. We still have, in a lot of cases, asset prices going up like this. And so private equity may or may not be able to get any good deals this quarter, in the fourth quarter, but we shall see. Thus far, when I look at all of the earnings of the banks that have reported, it actually looks way better than expected. I mean, non-performing loans increased, yes. Credit losses increased, yes. Everybody provisioning a lot more for credit losses, yes. And even at the expense of their own numbers looking a little bit funky, even though otherwise they would look great. Am I actually seeing the losses? Baby hair, and certainly below pre-COVID times. So that's all I have for Blackstone. I figured I'd keep it short. I appreciate you guys coming in, because I know this is a little bit more advanced than some of the other videos I do, and private equity isn't everybody's cup of tea. But I would definitely watch for Blackstone if it comes for sale, or if any of the private equity firms, the three that I covered, come for sale, they may be opportunities. Apollo and KKR both also have a lot of capital on hand. I preferred Blackstone at the time because they have just so much more cash, even than the two of them at 19%. But the truth is, all three of them are doing just fine. That's it for now. Have a great night. Take care. Bye.